The Secret History of Currencies, the Silver Explosion, December 11th, 2025. The ticker for silver flashes a staggering $6,358. Broadcasters are losing their minds over this historic peak, and the mainstream press is busy painting a picture of a triumphant market. Retail traders, gripped by a frantic need to get in before it's too late, are throwing money at the screen. But beneath this layer of polished news, a darker truth remains unspoken. This record isn't a fresh development. The fuse was actually lit weeks ago within the labyrinth of London's financial district, where a systemic failure occurred that the general public has yet to grasp, while the masses cheer for the green numbers on their phones. The real drama is unfolding deep inside bullion vaults at the Secret History of Currencies. We look past the surface, and the data suggests that $63 isn't a peak to be feared. It is a launchpad. The snare has been pulled tight. The trajectory isn't aiming for a modest $70. The mathematical fallout from the chaos of October and November indicates a seismic shift that will fundamentally rewrite everything we thought we knew about precious metals. Let's peel back the curtain on that December 11th surge. Yes, the price hit $6,358. While that stands as a nominal milestone, the why is far more significant than the what. Just 24 hours prior, the Federal Reserve had trimmed interest rates by a quarter point. It was a textbook move, fully anticipated and baked into every analyst's spreadsheet. Under normal circumstances, silver might have edged up slightly. Instead, it went vertical, gaining $245 in a single afternoon, a 4% leap in 24 hours for a metal traditionally viewed as a stable store of value is unheard of. To put that in perspective, imagine gold moving with the volatility of a speculative tech stock without a war or a global pandemic to blame. This happened because the Fed's rate cut wasn't the cause. It was simply the spark that hit a massive pile of dry tinder pressure that had been mounting for months while the trading world looked the other way. Most observers are misinterpreting the engine behind this move. Usually a weaker dollar pushes commodities higher. That's Economics 101, but silver didn't behave like a commodity. It behaved like a resource in a state of absolute scarcity. It was being chased by desperate entities requiring physical delivery, not just digital promises or paper certificates. You could see the warning signs throughout early December. While other assets fluctuated, silver refused to give back its gains, hovering stubbornly between $57 and $60. This wasn't a standard search for a middle ground between buyers and sellers. This was what happens when supply is choked off and demand is relentless. It was a market where the actual metal had already been claimed, and every policy shift from the Fed only tightened the noose around short sellers who had promised to deliver metal they simply did unpossess. To understand why $63 is just the opening act, we have to revisit October 2025, the month the trap was truly sprung. Something unprecedented occurred in London that should have been a global headline, yet it remained buried in technical reports. The cost to borrow physical silver, the lease rate catapulted to an annualized 200% for overnight loans. Let that sink in, a 200% interest rate just to hold the metal for one day. Normally these rates sit between 1% and 3%. Even during the height of the 2008 collapse, they only touched 20%. A 200% rate isn't a sign of market tension. It is the sound of a system breaking apart. At the Secret History of Currencies, we track these anomalies because they reveal who is truly in trouble. Who pays those rates? People who are legally obligated to hand over silver they don't have. Banks that sold paper silver but are now facing clients demanding the real thing. StoneX's Rona O'Connell summarized it perfectly when she noted that the London market had effectively run dry. London is the heartbeat of global metal trading, and in October 2025, that heart skipped a beat. The statistics tell a haunting story of depletion. In mid-2022, London's vaults held over 31,000 metric tons of silver. By early 2025, that stockpile had withered to roughly 22,000 tons, a staggering one-third disappearance in less than 3 years. By the time those lease rates hit 200% in October, the available silver for immediate trade was essentially non-existent. Every bar was already tagged for someone else. This was the moment the door locked on anyone betting against the metal, but the plot thickens when you look at how the authorities reacted. Just weeks later, in November, the United States government officially reclassified silver as a critical mineral vital to national security. This wasn't just a bureaucratic label, this designation is a break glass in case of emergency move reserved for materials that are essential for defense prone to supply shocks and controlled by foreign interests. Silver now sits on the same priority list as lithium and cobalt. Washington saw the dry wells in London and realized the U.S. had a strategic nightmare on its hands. Between the relentless needs of solar energy, the AV revolution, and the massive hardware requirements of AI, we are facing a national security gap. The $63 price point is just the world starting to wake up to this reality. The genuine climb, the move that ventures into triple digits, is only just beginning. Once the realization hits that industrial giants are about to go to war over the remaining scraps of physical metal, $63 will be remembered as the deal of a lifetime. The math is inescapable, even if Wall Street prefers you didn't do the counting. The Silver Institute's late 2025 data paints a grim picture. This year miners will pull about 830 million ounces from the earth, but the world wants 112 billion. That leaves a massive 307 million ounce hole. This isn't a one-time fluke. It is a structural rot. For 5 consecutive years, we have eaten more silver than we have produced. We've been living off the savings account of above-ground piles accumulated over decades, pretending that paper trading can mask a physical deficit. But as the empty vaults in London prove, the savings account is empty. Philip Newman of Metals Focus put it bluntly at a recent industry gathering. Mining is stagnant while high-tech demand is soaring. You cannot solve a physical shortage by printing more paper. You can only solve it with a price high enough to force people to stop buying. Consider where the remaining metal is hiding. As of late 2025, the iShares Silver Trust, SLV, alone holds over 15,000 tons. That's nearly 500 million ounces, or more than 60% of an entire year's global mining output tucked away in a single fund. When you add up all the other ETFs, you realize that nearly a full year of mining production is locked in vaults, serving as investment hedges rather than being used to build the world's infrastructure. This creates a feedback loop. As the price climbs, more investors buy the ETFs, which forces the funds to buy more physical metal, which further starves the industrial sector and sends prices even higher. Morgan Stanley recently described this as a self-reinforcing supply squeeze. There is no easy way out of this cycle. The industrial hunger for silver is not optional. The solar sector alone now devours nearly 30% of all mined silver. There is no plan B for silver in solar panels. Nothing else conducts electricity as efficiently. The same goes for the brains of electric vehicles, the cooling systems in AI data centers, and the backbone of 5G networks. We are looking at a world where industrial users will soon require over 80% of all silver produced, leaving almost nothing for jewelry, coins, or investors. The market is broken, and the October panic was the first crack in the dam. To understand the scale of what's coming, we have to fix our perspective on history. While $63 sounds high, it is an illusion created by inflation. The 1980 peak of nearly $50, which was driven by the Hunt brothers' attempt to corner the market, would be worth about $200 in today's money. This means that despite the all-time high, headline silver is still trading at a 70% discount compared to its true historical peak. And unlike 1980, which was fueled by the greed of 2 billionaires, today's move is fueled by the basic survival needs of the global economy. If a few wealthy individuals could push silver to an inflation-adjusted $200, where does a total global shortage take it? The cumulative deficit since 2021 has now crossed 12 billion ounces. That is a year and a half of global production that has simply vanished from our reserves, with no major new mines scheduled to open for years. 2026 is looking like a collision course as we look ahead at the secret history of currencies. The milestones are clear. By the first quarter of 2026, as Asian manufacturing reopens and the Fed likely continues to ease, we expect silver to challenge the $70 to $80 range. By the summer, as solar installations hit their peak and physical stocks are tested once more, $100 becomes a very real possibility. By the time we reach the end of 2026, with industrial giants in a state of full-blown panic buying, $120 could be the new baseline. The $63 record isn't the headline, it's the warning shot. The physical metal is gone, the demand is unstoppable, and the only thing left to move is the price.